Hey, what's up, my friend? So accompanying me today is this two pair of drumsticks, right? The reason they're with me is because I confiscated them from my son, because while I was producing this video, right, he's out there, drumming, thinking he's the latest, hottest drummer out there, and it's affecting my videos, right? So I confiscated, right? So without him having it, he can't kind of like interrupt my video, right? So anyway, in today's video, something special, right? Because it's something I haven't done in a while, and I'm going to share with you my take on the US stock market, because I get it, right? Traders are thinking, man, is this a good time to buy, right? The stock market has rallied, right? 20% from these lows over here, right, to where we are here right now. But then the fundamentals of the market, the US is in debt, what if they can't pay back their debt? And look at the banking contagion, right? SVB, Silvergate Bank, right? All getting into trouble. Should I buy or should I sell? Great question, right? So this is why in today's video we're going to find out, right? So the way I'm going to do it is I'm going to share with you bullish factors, right, which are good for the US stock market. At the same time, right, not all is rosy, because there are some bearish factors to be aware of as well. So we kind of like assess both of them, right, the pros and cons, right? Then from then we kind of like come up with a decision, right, whether should we be buying or selling stocks. So the first thing that I want to look at is the technicals, because I am a technical trader. I focus a lot on the technicals, and looking at the technicals, this is the daily time frame. You can see that the US stock market has been pretty much in a range, right, over the past 1 year or so. So this will be the highs that I would highlight out, and then this will be the lows. Okay, so from a daily time frame perspective, it's in a range between the highs and lows. And of course, right, if you take a step back, you zoom out, that's where you get a different picture. So this is the weekly time frame. We zoom out a little bit, right, and you can see that now, okay, the US stock market, the picture is now different. So let's break down the recent 1 year of price action, or maybe 1 or 2 years. So you can see that in 2022, right, the stock market, of course, right, it took a beating, right? You know that already. Down about 20%, right, for the S&P 500. Notice a series of lower highs, right, and lower lows, lower lows for a good part in 2022. Okay, and then what happened is that sometime towards October of 2022, this lows over here, right, kind of like bottom up and then had a nice rally up towards this 4,200 level price point. So if you look at the price action, right, what I'm seeing over here is what we call a inverse head and shoulders pattern. Not the most textbook example, but you can roughly see the left shoulder, the head, and the right shoulder, and this will be the neckline. So from a technical standpoint, if the market can break and close above the area of resistance, right, this means, right, the market could possibly rally up higher and take out this all-time high over here. So from a technical standpoint, I would say things are looking bullish, right? As you can tell, buying pressure is stepping in, right? This is the swing low over here. Selling pressure couldn't take this down lower to break below this swing low. Instead, what we got was a series of higher low, and now the price coming back into this area of resistance. Okay, so you can see over here, in fact, we can actually possibly even draw like a trend line, right? You can see over here like something like a mini ascending triangle. So if the price once again breaks above the 4,200 level price point, things will pretty much be looking good for the stock market, and wouldn't be surprised if it retests these highs over here. So that's from a technical standpoint. What about fundamentals? Let's walk through a few fundamentals scenario of factors. First one is the Fed fund rate market expectation. So what this is, right, if you're unaware, is basically the market's expectations of interest rates. So you can see over here, to break it down, in June, it's expecting about 5%. July, about 5% as well. So you can see that there. Oh, by the way, this one is not cast in stone. This meaning these numbers, this percentage is always fluctuates up and down, right? So it changes over time, right? But as of right now, the rough pattern, right, is that we are expecting interest rates to kind of like pause or take a plateau, right, sometime in June and July. So we're not expecting higher interest rates, and after which interest rates could possibly head down lower for the rest of 2023 and 2024. So again, that's kind of like the market's expectations right now. And of course, this can change. For example, wait, the next CPI, the Consumer Price Index report, comes up, inflation is 10%. Guess what? The Fed will likely raise interest rate further, right? So again, this is not a cast in stone. This is kind of like dealing with probabilities, and this is what the market is expecting right now. A pause in interest rates, and then a decline in 2023 and 2024. So what does this mean for the stock market? Well, this is bullish, right? Because when interest rates are low, it means that companies can take on more debt cheaply. I mean, they can take on more debt, they can expand, right? Increase their earnings, and then naturally, lead to increase in stock price. So low interest rates are usually good for the stock market, and that kind of like explains the huge rally we've seen, right, from 2009 all the way until the 2019-2020 period, right, in the low interest rate environment. Next thing to look at is the earnings, right? How did the S&P 500 earnings, fare recently? So this is again published in May 19. You can see over here the earnings scorecard. This is important, right? 78%, right, of the S&P 500, right, has actually beat earnings expectations over here. So this means that more than 3/4 of the companies reporting in the S&P 500 has beat earnings expectations. So they actually earn more money, right, than expected, right, by the analysts, right? So again, you make more money, right? This means that, the company is healthy, and chances are, stock price will reflect upon it, right? So it's good for the stock, right, overall. So far earnings is, looking good for the stock market as well. Now, what about this one over here, right? So now instead of, looking at all the bright side, this is a few factors, right, that could affect the US stock market. It's the banking, right, crisis, right, that we have seen recently. So for example, Signature Bank, went down, Silicon Valley Bank went down, right? And what's interesting is that the size of these two banks is large, right, relative to the banking crisis that we had in 2008-2009 period, right? So most of the banks that went down back then is smaller, right, than these two recent banks. And one thing about bank, right, is that the crisis is not just isolated to one bank, because they're all interconnected, right? Bank A lend money to Bank B lend to Bank C lend to Bank D, Bank D lends back to Bank A, and you can see that it's all interconnected web, right? So when one bank goes down, right, and the creditor, the banks that is being owed money, couldn't get their money back, that could actually affect their operations, and they could also in turn go bankrupt, right, if their liquidity, they don't have much cash flow, right, to support their operations. So you can see that if one bank goes down, right, multiple banks, right, they're all connected to it with not very strong cash flow, right, could also go down along with it. So this is why we have this kind of like a banking contagion out there. So the fear now is that, these two banks, right, rather it's actually three banks. Let me just point out to you the next slide. These three banks over here, right, could just be the tip of the iceberg, right? And if there are other banks, connected to it that have cash flow problems, they, couldn't repay back their debt, and this could, lead to another banking crisis. So that's the worry right now in the market. But in my point of view, I wouldn't worry as much, right? Why is that? It's because the Fed, right, they love bailing out banks, right? They don't want the banks to fail. They're like the lender of last resort, right? You got no money? Don't worry, Papa give you some money. Go use the money and survive, and don't give problems in the market. So that's what the Fed is likely to do, because this has been their course of action, right, over the last few years, last many years, right? They always be the lender of last resort and lending the bank money, right? So I wouldn't expect a banking crisis because of the Fed, but in the grand scheme of things, just to digress a little bit, right, end up is the taxpayer are the one who actually, kind of like bear the cost, right? Because it's taxpayers' money that's actually, bailing out these banks, right? So I don't want to get sidetracked a little bit, right? I won't be too concerned about the banking crisis, right? Because the Fed, usually acts as a lender of last resort. And what about this? The US debt, right? The US debt has, risen, right? Astronomically, right, over the last few decades, right? And there's the US debt ceiling, and right now, if the debt ceiling it's not lifted, right, what's going to happen is the US will go bankrupt. So should it be a cause of concern? Well, looking at this chart, you can see that since the 1980 to where we are right now, the US debt ceiling has consistently increased over time. So I'm betting that 99% chance, right, that the US debt ceiling will increase again. And also, right, the debt ceiling is kind of fake, right? You look at this point in time, in fact, I think 2019 or 2020, the US debt ceiling can even be suspended. It means you have a credit card with unlimited spending amount, spend and spend and spend, right? So the debt ceiling is kind of like, yeah, it's fake, right? You can just lift it up, right, whenever you need to. So what's the point of having a debt ceiling in the first place? I wonder, right? So they probably have a reason for it, why they even started it, but I'm not going to dive into it. But the main thing is that I won't be too concerned about the US debt ceiling, because it's just, it's just an illusion, if you want to call it, right? And it's kind of like, a father, right, always giving his son money, and the son always borrows money from the father, and the father keep giving. The son, doesn't spend the money wisely, always, blows it up, spend it on useless stuff, and still goes back to the father and to borrow more and more money. And the father still gives it, and you wonder why. Well, the reason is because, right, the father doesn't want the son to go bankrupt, right, because it reflects back badly on their family name, right? So same thing, and it's the same thing what the US is going through right now, because if they go bankrupt, they make them look very bad, right, in front of the world, and I don't think that's a path that they want to go to, and of course, right, the repercussions, right, that will come along with it. Yeah, so let's do a quick recap, right, to the factors that we have just covered so far, right? So we covered these few factors, and to sum up, the technicals, I would say, is bullish, right? As you can see over here, long-term uptrend, and there's a recent inverse head and shoulders pattern. The Fed fund rates, right, expecting interest rates to go down lower, so again, that's going to be bullish for the stock market. Earnings has been bullish for the stock market, as you have seen most companies beating earnings expectations. What about the banks, right? So yeah, there is a possible banking contagion, right, that could lead to a decline, right, in stock market sentiment and prices. But remember, there's a Fed, right, who's usually the lender of last resort, which I believe that they will step in, right, and inject more liquidity and flood them with more money if they need to. So wouldn't be too worried. I think it's more towards neutral, right? They are neutral, so let's put it like a dash. And same thing for US debt, right? They're probably going to raise the debt ceiling again, so wouldn't be too worried. Probably neutral as well. So overall, I would say there are more factors, right, to be bullish on the stock market than not. So now the question is, what stocks do we buy? Well, let's find out. Now, let's have a look at a trading setup I'm keeping my eyes peeled on, right? It's none other than Decker's Outdoor Corporation. So give you a little bit of a context, right? As you've seen earlier, the S&P 500, the price action now of it is actually more of a range bound like this on the daily time frame. You can see this is the price action of the S&P 500. Whereas if you compare with DAX, right, you can see that in terms of relative strength, right, this stock is a lot more stronger. It's in a very nice bullish uptrend. And that's not all. If you go up to the weekly time frame, it's actually trading at all-time highs, right over here, all-time highs. I believe so. Let me just zoom out a little bit, right, to confirm. Okay, yeah, pretty much at all-time highs, right? It's been around since like 1993, 1994, right? Amazing. So, yep, the stock is showing signs of strength. Just recently broke out of to all-time highs. And also, you can pay attention that the price currently is retesting towards this previous resistance, which could become support on the weekly time frame. So let me just highlight that out, right, so you can see it over here. Where is the rectangle tool? There you have it. Okay, so I'm just going to highlight the box so we are all kind of like looking at the same thing. Okay, so this is the weekly time frame level. So you go down to the daily time frame, okay, so you can see that this box was highlighted earlier. So daily time frame, if you look at the price action, right, again, similar. Market is in a very nice uptrend. You overlay with the 50-period moving average. Often people ask me, Rayner, is it the simple moving average or the exponential weighted moving average? To be honest, it doesn't really make much of a difference, but in this case, I believe it's a simple moving average, right? The 50-day simple moving average. And you can see that it's respecting it pretty nicely, right? You know, bounce off here once, then go up, come back, bounce, down, up, down, up, down, up. And we're back here at the 50-day moving average once again. And another thing to also pay attention to is the price action of this market. I'm going to remove the 50-day moving average first. And notice that this market has a tendency of faking out the previous swing low and then, you know, rebounding back up higher. So for example, this is the prior swing low. Price came down into this level, right? Took out this lows, took out the stop loss that were placed below it, and then had a nice bounce up higher. So same thing over here as well. This was the prior swing low. Price came down lower, took out this lows, took out the stops below it, and then had a nice bounce up higher. So what I'm looking for again for this particular setup is again similar. We have multiple confluence factors coming in our favor. Number one, we have this area of support that you've seen on the weekly time frame, previous resistance that could become support. Number two, this is a swing low over here, and the price could possibly, you know, take out this lows and then quickly rebound back above it, right? So it could be in the form of like a hammer candlestick pattern showing you a bullish price rejection. And of course, number three, you saw that it has confluence of the 50-day moving average, where, you know, earlier I brought it out. We have this 50-day moving average confluence as well. So these are a few factors that, you know, is working out for this stock, right? The few factors that I think is a bullish sign. So what I'm looking for is, again, if the stock price could show me a bullish price rejection, like maybe in the form of a hammer, taking out this lows at this area of value, at this area of support, I'll be looking to enter on the next candle open. Or sometimes I place a buy limit order if I'm feeling a little bit of a cheapskate. My stop loss is usually a distance below this lows because I don't want to exit to get stopped out prematurely. So usually something along here. This would be my stop loss. So this is my entry. This will be my stop loss. Okay. For potential targets, right, one level you can reference to is just before this recent swing high, right? Let's call this TP. Okay, so this is a potential trading setup that I will be looking at. Could possibly look to capture that one swing up higher, right? If the market comes into our area of value, give us a valid entry trigger, and those will be the entry, the stops, and target that I will be looking for. And of course, if you want to, you know, as you've seen this stock, right, it's in an uptrend. If you want to continuously hold your position to ride the trend up higher, you can as well. So one technique to share with you is that maybe instead of capturing a swing, what you can do is you can use maybe a moving average to trail your stop loss, like maybe the 100-day moving average. Or you can even reference, you know, price structure to trail your stop loss, meaning that as the price continuously make a series of higher highs and higher lows, you continuously hold the trade, right? But if it breaks
and close below, let's say, the previous swing low or the previous area of support, it breaks and close below it, then you exit the trade. So there's a trade, another method, right, that you can, trail your stops and to ride the trend up higher. So again, different ways, different folks for different strokes, right? Kind of leave it to you to which trade management you prefer. But this is definitely a potential trading setup that I'm keeping on my radar.
And by the way, right, if you were to level up your stock trading, right, then I'd like to invite you to this webinar called Stock Trading Secrets, right? So during this webinar, we'll cover a few things, right? I'll share with you the fastest way you can become a consistently profitable trader, even if you've tried everything else and failed. I'll share with you how you can actually generate consistent profits almost every single year in the market, regardless of whether it's a bull market, bear market, or even during a recession. Plus, I'll share with you a way, right, to grow your account to 7 figures and beyond, even if you have a small starting capital and with relatively low risk. And also, we'll talk about a proven trading system that has generated 3,225% over the last 22 years. I'll share with you the exact trading rules of this system, right, chart examples and much more. So if you're interested, right, you can just come to this website over here, tradingwithrayner.com/STS, right, and just sign up, right? This event is free. And again, I wish you good luck, good trading. I'll put the link somewhere below this so you can sign up for this event, and I'll talk to you soon.